On April 2nd, 2025, President Trump signed Executive Order 14257. It imposed sweeping tariffs on foreign imports, declared a national emergency over the U.S. trade deficit, and promised to reset America's economic footing. The administration called it Liberation Day. The markets called it something else. That day, the S&P 500 dropped 4.84%. The next day, it fell another 5.97%. 2 more consecutive losses followed. Investors panicked, headlines screamed, and for a moment, it felt like the bottom was falling out. But then came April 8th. Just 4 trading days after Liberation Day, the S&P surged 9.52% in a single session, one of the biggest one-day gains in its history. By April 24th, the index had fully recovered, sitting higher than it was before the tariffs were announced. If you'd bailed out during those first chaotic days, you would have locked in your losses and missed the rallies that came roaring right behind them. Jack Bogle, the father of index investing, once put it this way: the idea that a bell rings to signal when investors should get into or out of the market is simply not credible. After nearly 50 years in the business, I do not know of anybody who has done it successfully and consistently. Today, we're going to look back at some of history's ugliest market days and the surprising rebounds that followed to show why trying to time the market is a losing game. You may get lucky once or twice, but over the long run, time in the market beats timing the market. Welcome to Plan to Prosper, where we exist to honor God by equipping faithful servants to steward their finances wisely and build wealth that endures for generations. All right, Logan. Today on Plan to Prosper, we're talking about market timing and looking back at some historical events where the markets went down and discovering how quickly they rebounded and investors potentially missed out on those rebounds.
Yeah, great to be back. Big flip from the last episode you guys had, going from fitness to now markets.
A little bit, but you as the investment genius and expert in our firm, it makes sense that we visit this a little bit because we had a major event this year that caused a pretty significant market downturn. And I mean, we work with clients every day, and there was a lot of nervousness, right?
Yeah, it is. It is interesting. I feel like a lot of people think about investing and think of statistics and more kind of science, where you do have to definitely think about investors' emotions a lot and your own emotions and kind of fight against your emotions in those times where markets can get volatile.
And the emotional side of things, it's really natural when the market goes down and you see that account balance has shrunk, maybe even significantly. The natural reaction is, I got to get out before it gets worse.
Yeah. Studies, I don't remember which study or anything, but I'd read at one point that the negative, if you're up 5% or you're down 5%, up 5% you have the positive emotion, down 5% you have the negative emotion. The negative emotion with the same, essentially the same up versus down is stronger than the positive emotion for everybody, if that made sense.
It does. I think it was Cam Newton after he lost the Super Bowl said, I hate losing more than I like winning.
Oh, yeah. Didn't Hurts say something like that too?
Yeah.
I think Cam Newton said it, but I think Hurts said something similar
and
as well.
We'll give credit to Jalen Hurts. But he's better than Newton. So, but yeah, there's this natural of course my account's up. That's just what it does. And then it goes down. It's like whoa. Yeah. Hit the panic button. Let's get out of this.
This does not feel good.
Yeah, and honestly, I sympathize with that because there is this tendency I have to protect what's left, and there's what's left, and there's some level of natural. I'm trying to think of how to say it, but wanting to preserve and not see worse losses happen makes sense. Except for the fact that we're not looking at these things. We shouldn't be looking at our investments as a short-term thing. We should have longer time horizons in view when we think about our investment accounts.
Right, and there's really no such thing as an investment that's going to provide a lot more than the risk-free rate without the risk of downside.
Exactly. Yeah. And so today we're going to look at 5 examples of market crashes and different rallies that happened and how quickly they happened after it.
5. Did you include my bonus that I'm going to talk about?
Yes.
Okay.
but it'll just be a quick little thing. I mean, that one is interesting. We'll get to that one. It's going to be at the very end. But the point is, even just missing a handful of some of these good days that follow these market crashes will have a significantly negative impact on your portfolio. And we don't want to see that happen to anybody.
Yeah, absolutely. Part of the long-term strategy is capturing those up days after you've been in a down day.
Yeah. All right, let's take a look at 5 real examples where some of the worst days were followed by some of the good days and what would have happened if you missed them. All right, example number 1, we're kind of going chronologically here, and we're going to start with the heaviest hitting one, potentially, in terms of the overall impact of this one. And it's October 29th, 1929. For months, stock prices had soared to unsustainable levels, fueled by speculation and margin debt. People were borrowing heavily to buy stocks, convinced prices would never fall. When reality set in, panic erupted. On that single day, the Dow plunged nearly 12%. By the end of the week, billions of dollars in paper wealth had vanished, setting the stage for the Great Depression.
The interesting thing about what you just read there is people were convinced prices would never fall. I was reading a little bit about this. I had never heard of this, but there was apparently what's known as the Forgotten Depression from 1920 to 1921, where the market was down 50% and corporate profits were down 90%.
Really?
And yet after that, people seemingly forgot that the markets could fall.
Yeah, because clearly we all think of the 20s as, I mean, the Roaring 20s is the name that is applied to that decade. And
it's Great Gatsby where everybody's throwing huge parties.
Right. And that's what we think of. And that makes sense in the context of the Great Depression, that this was not a sustainable thing. But I didn't know that. I didn't know that there was a crash at the beginning of that decade. Yeah, it's amazing how quickly, and it goes back to your emotional thing. Like or maybe not. Maybe in this case, the emotions were riding high on the good markets, and they quickly forgot about the down markets. So there's some interesting psychology at play here too. But yeah, markets fell on that Black Tuesday in October of 1929, and obviously continued to tumble. But there were some good days mixed in here too. And if you really panicked and got out of the markets right away, you would have missed on some of those early rallies. There was multiple 10% single day rallies. On October 30th, just the next day, the S&P rose 12.53%, which is the second highest single day gain in its history.
Do we know what the first was? Is that in our list? I can't remember.
No.
The first highest.
I think it's somewhere within the Great Depression, if I recall. Okay. But the one the rally that happened earlier this year was like the 8th.
Yeah, it was. I think the NASDAQ was over 10, but the S&P was like 9.8, something like that.
So this one is, we kind of need to present a little bit of a caveat in the Great Depression, that the markets it took a long time for the markets to really recover to pre-depression levels.
I think one of the differences, though, is the run-up to the Great Depression was unbelievable.
Yeah.
For the 5 years prior to the Great Depression, the Dow was up, I think, like 500%.
Wow. That is nuts.
Yeah.
But nevertheless, they were there. And,
yeah.
And to get back to that level, it didn't happen until like the 50s.
Right.
But we were out of the Great Depression for a while at that point. Mm-hmm. But nevertheless, the markets didn't recover to those pre-depression levels until the 50s.
Yeah.
November of 1954.
Yeah. Yep.
So this was not just your normal crash. This was a generational catastrophe. But even in the midst of that, there were these massive single-day rallies that you did not want to miss out on, because you would have locked in even larger losses had you missed out on those.
Right. Yeah. And there were a variety of reasons that the depression happened. The Fed was young, and I think there were some controversial decisions made where it was almost like they were even experimenting with interest rates and money supply and all of that. I read this, I don't know the exact number, but it was thousands. They let thousands of banks fail.
Wow.
Whereas we'll talk about it a little bit, but in 2008 there were like bank bailouts.
Yeah, right.
So yeah, there were a number of things at play there.
Yeah. And we talked about this a couple episodes ago, that as a result of the Great Depression and the market crash that happened, a lot more regulations came into place around investing in the finance world in general. So
right.
There were some things that happened that needed to be tightened up, and that were as a result of the Great Depression and the market crash there. So I think the key idea here, and that we're going to notice this throughout all these examples, that good days and bad days kind of travel together, and it's really difficult to know which is happening next and when to sell, when to buy. If you're trying to make those market timing moves, you're going to have a harder time as opposed to just staying the course and just keeping your money invested.
Yeah. Nobody knows the future.
Right. All right. Our next example. Again, October. What's with October? We have October's coming up, and October 19th.
However, historically, September is the worst month for investing.
Is that right?
Returns wise, yeah.
Well, on October 19th, 1987, global markets collapsed in unison. Rising interest rates, inflation fears, and overvalued stocks set the stage. But the real accelerant was a new computer-driven program trading, which automatically dumped stocks as prices fell, creating a vicious cycle. By the end of that day, the Dow had lost 22%, the largest one-day percentage drop in history.
Yeah, this was interesting, again, 1987, so prior to either of us knowing the markets or being born. I had never heard of this, so I looked into the computer-driven program trading. Was one of the big ones, at least, was called portfolio insurance, where it would like automatically, as prices were falling, they would just start selling off stocks in the portfolio.
That's crazy.
Yeah. I don't know all of the mechanics about it and why I guess people thought it was a good idea back then, but it ended up accelerating a trade-off.
Do you know how long that was around for? Like, was it quickly like, let's forget this? It's just not a good idea.
Yeah, I'm not sure.
I want to look into that. I'm curious. That's weird. But yeah, the very next day, so the Dow drops 22% one day. The next day it was back up 5.3%, which is a huge amount in one day. I know we're talking about some other bigger numbers here, but 5.3% is a big one-day rally.
Yeah, yep.
And there was more gains ahead in the weeks ahead. So an investor that bailed on Black Monday, as it's known, would have lost 30% more than somebody that just stayed invested.
Right. And it's also easy. So when you read about 1987, it's easy to kind of play what's called Monday morning quarterback because there were things that kind of led to people getting nervous. There were different pieces of legislation. I think one of that, something that was submitted made it seem like it was going to be harder to finance mergers. There was another, the dollar was starting to decline. So there were things that looked like the markets might get choppy or we might hit a weak market, but nobody can call a day in which the market's going to fall 22%.
Yeah, exactly. And to panic in a day like that is just so detrimental when we acknowledge and sympathize with the fear that comes with that, because that your portfolio would look a lot different after that day than it did the day before. So
and it does practically affect some people. If 1987 if October or November of 1987 is when you want to retire,
of course
you're going to be affected by being in the market that day.
Yeah. And this is certainly the demographic that it most certainly impacts the most. If you're young, you really should just have much longer time horizon and longer term goals. But if you are retiring or have just retired, that is most certainly a nervous thing to experience, a difficult thing to experience. And yet, even so, you still have enough time to stay the course. Hopefully, you have a financial advisor that can help you think through these things and help keep you grounded when the nervousness does set in. And that's something that we try to do with our clients all the time. If there's anxiety about where this is going, we want to try to calm those nerves a little bit as best we can with the way that we talk about it and not get nervous ourselves.
Right. Be like the flight attendant.
Exactly.
As you're going through turbulence.
Yeah. My father-in-law's a pilot, and so he has a small plane that he flies, and I've flown in it a few times. Small planes are worse than big planes because they're very turbulent. You feel everything. But the nice thing about it is I get to sit right next to the pilot. And I was in a plane with him once, and the thing dropped legitimately 10 feet in the air with some turbulence. Oh. It was awful. And I looked over at him, and he started laughing. So I was like, okay. I was still nervous, but it was a little bit better because he was right there, and he's like, there's literally nothing to worry about.
So do you think he's never nervous?
Never.
Wow.
I ask him all the time because he's never nervous. So it is nice flying with him.
Yeah.
Yeah, that's Black Monday, 1987.
There was also, I think it was the first mention, but the chair of the SEC during Black Monday talked about potentially halting the stock market. And we've since seen that happen multiple times. I think, I didn't read enough into it to know if this is accurate, but I think this was the first time that there was talk of halting the stock market, which I think I was reading like Investopedia or something. The talk of halting the stock market made investors even more nervous, and wanted to sell even further.
Yeah, man. And am I correct? I should have looked into this. Like the 80s, similar to the Roaring 20s, maybe not to that extent, but prior to this, things were going fairly well economically in the stock market until 1987.
Yeah.
So that makes sense that these crashes tend to come after a period of fairly significant growth in the markets.
Yeah.
In the late 1990s, there was a gold rush in Silicon Valley. Companies with little more than a website and a dream were trading at sky-high valuations. Investors poured money into anything ending in .com. But by 2000, earnings never materialized, and reality hit hard. Between 2000 and 2002, the NASDAQ lost nearly 80% of its value. Retirement accounts tied to tech stocks were gutted, and many companies disappeared altogether. So this is the .com bubble.
Yeah, this is an interesting one again because people look back and think, what were people thinking? These companies were making no money, but people got excited, and there was definitely a build up. The bubble had a kind of a gradual, widening, ballooning, where people were buying these companies and enjoying the run up until it eventually popped.
Yeah. So over the course of 2 years, the NASDAQ, nearly 80%. It was about 78% of its value in 2 years, just completely dropped, which is crazy. So that's a huge drop, but many of the top 20 NASDAQ single-day gains happened during this crash.
Yeah, yep. So yeah, again, your portfolio is going to lose value, but historically the stock market does come back, and you want to be there when it does. Yeah.
That's the risk of investing and the volatility, but volatility cuts both ways.
Right.
The gains come as well as the losses. So the historical bet is that there are the more good days than bad days, and over the long run, you're better off just staying invested, even when it makes you nervous and it feels like a historical event, right? Like I can see how in that situation, we've never experienced this before because the new fandangled internet is here and all of a sudden none of these companies have any value. Forget this. Like I can see how that mentality could happen where like this is historic and unprecedented. I have to get out before this thing completely disappears. But the reality is that it wasn't. The NASDAQ's not still down 80% from
right.
You know what I mean?
That's also the interesting thing about this crash is that it hit the market in very different ways. Like in 2000, I have a chart where there are 10 different sectors that you can look at. In 2000, tech was down almost 41%. Utilities were up 57%. So that also plays to the benefit of diversification.
Right.
If you're not just in tech, you're hopefully in some things that are providing value as well.
Yes.
It was 2000, 2001, tech was down 27%. The interesting thing, though, with this market, I've never really looked into it. Utilities in 2000 were up 57%, and then in 2001, down 30%, and then in 2002, down 30%. So, yeah, but tech was amongst the losers in all 3 years, 2000, 2001, and 2002. And then the other sectors kind of moved around, with 2000 having 6 sectors that actually provided positive returns. 01 had 2 sectors that provided positive returns. 02, everything was red.
Wow. Yeah. Yeah, we believe in diversified portfolios because there's sometimes negative correlation where when some markets would be down, naturally other ones would be up, or at least to staying the course. So that can help mitigate a lot of the downside, especially if you're just heavily concentrated in one sector. That's a very risky move and can put you in a really bad position if it goes down, when it goes down.
Yeah. Do you know any of the big companies that went down?
In the .com bubble?
Yeah.
The one that stands out is was it pets.com or?
Yeah. That's probably the most well known.
Yeah.
I looked into that one a little bit. They were selling pet food to people, and the shipping costs were more than people were paying for the actual pet food.
Unreal. Yeah. It's especially funny in this day and age when we're so used to free 2-day shipping. Right. Like that's just a standard thing, thanks to Amazon or whatever you think of them. But nevertheless, yeah, the idea that the ship, I wouldn't even buy it. Like if I see shipping, I don't even like seeing shipping costs anymore.
Yeah.
But if I see it certainly anywhere close to the price of the thing, I'm not going to buy that.
Yeah. Well, but that's why they were losing so much money.
Yeah.
The other interesting one, this one feels like just unfortunately, way before their time. Webvan was a company that went down.
Okay.
They were a company that essentially you could get online and order groceries, and they would deliver your groceries.
Great idea.
Yeah, that is Instacart today.
People do that. Yeah, right.
Yeah.
Well, I'm just curious why it didn't work, or what.
I think they ran out of. They just kind of ran out of investment, like money. Basically, I read that there was a bunch of warehouses that when they shut down, they had to figure out what to do with all these warehouses.
Yeah.
I do wonder if the bubble lasted a little bit longer, if it would have been successful. Internet was still relatively new. I wonder if people just didn't trust getting on the internet to order groceries.
Yeah.
I mean, sometimes I still think, somebody else is going to pick out my produce.
Totally. Yeah, it's funny. When I first heard about this, because I was certainly alive for this, but I was like 10 years old or whatever. So like I didn't really pay attention to that at the time, or even realize that it was happening at the time. So when I first heard about this when I was a little bit older, it actually didn't make sense to me how this happened, because I go, well, this was in the early-ish days of the internet, and I look at what the internet is now and how you can easily build a company just on the internet in this day and age. How did this happen? Like, shouldn't all those companies have been successful without ever before looking into it and seeing that a lot of these companies maybe did even have good ideas, but it almost were ahead of their time, or just didn't. It was too early for it to be fully fleshed out to be successful. And
yeah, because another company that went down, again, surprising to me, it was called eToys. I hadn't heard of this one, but their main business idea was, we're going to compete against Toys R Us online.
Yeah,
we're gonna be we'll be the online presence. People can, instead of driving to Toys R Us and getting toys, they can just order them online and we'll ship them to people.
Again, that's Amazon now.
Yeah,
right. Like Toys R Us, as far as I know, they don't exist anymore, right? Or
they went bankrupt a few years ago, but I think they're starting to try to come back.
Yeah. As a side note, I do think it's gone too crazy, and how everything is done on the internet.
Yeah.
I think going back to some level of brick and mortar store, and I think would be a good thing.
I mean, I have great memories of like shopping around in Toys R Us, and even spending that 10 minutes where you go to the video game section and they had the video games out.
Mm-hmm. Yeah, I miss like renting videos. This is I don't know the economics of video rentals. I don't know how much money they would have made, like Blockbuster, but my family tries to recreate that a little bit, because everything's on streaming services now. It's annoying. You have to have access to literally every streaming service if you want to watch a particular movie. But we have a library card, and you can just go to the library and rent movies, and they have a pretty good selection. You can get almost anything you want there, and you don't have to pay for it. So,
what format do you?
DVD, baby.
Wow.
Yeah, so we have a DVD player, and we can rock those old school DVDs, man. It's pretty sweet.
No more. Did Blu-ray go away? Is it not big anymore?
It's a Blu-ray player, so
okay.
If we get a Blu-ray, we'll get that. So it's a little higher quality, but
I feel like Blu-ray
scales DVDs. So.
It wasn't very long-lasting, was it? I feel like it was like DVD and then Blu-ray, and then was streaming shortly thereafter.
Yeah, I mean, I remember when I was in high school, there was a battle. Actually, I don't even know if you remember this, and we're going way off the rails here. But Blu-ray was in a battle with this other version of DVDs it was just called HD DVD. So
I don't remember that.
Instead of the blue little cover on the top of the case, it was red, and that was like the two competing like high quality the new version of DVDs basically, and Blu-ray blew them out of the water and was the only thing. But yeah, streaming services obviously came into the play in the 2010s as like the way to watch movies, but I still like a good DVD. It's nice to go to the library, pick something out. The kids like it, and it's fun. Highly recommend it.
To try to veer it a little bit back, I think this also preaches the benefit of diversification. Nobody knew prior that Blu-ray would beat HD.
Right.
So if you're in a diversified portfolio, you might have both, and one goes up and one doesn't.
Yeah, exactly. Okay, the next one. This is the biggest one in our lifetimes, and everybody's familiar with it. But in September 2008, Lehman Brothers collapses. Mortgage-backed securities implode, and the U.S. banking system teeters on the edge. Credit markets seize up, millions face foreclosure, and the S&P 500 falls more than 50% from its peak. Headlines warn of another Great Depression. So we got the 2008 financial crisis. October of that year saw multiple 8 to 10% losses in single days. Pretty significant.
Yeah, very significant. This one I remember pretty well. I was a sophomore in college studying business, in I think my sophomore year. My big class was macroeconomics, so it was very applicable what was going on. I also just remember I had a variety of friends, some with relatively wealthy parents, and they would tell me, "Oh, I just talked to my parents and they lost, X amount of dollars today, or their portfolio's down." I just remember the emotion that friends were seeing in their parents because the market was just tanking.
Right.
So it's you definitely have to try to keep your emotion in check and think about the long term. But at the same time, I mean, the global financial crisis was, the worst in our lifetime. One of the worst, not as bad as the Great Depression, but one of the worst in most people's lifetimes. So when things are down, 40%, that's going to be hard for anybody to stomach.
Yeah. But again, there was good days mixed in, and on March 10th, 2009, so a few months later, the S&P 500 jumped 6.4% in a single day. That kicked off a decade-long bull market. And if you had gotten out earlier because you were nervous, you would have missed on those early runs. One of the things that we provide our clients is an investment portal where you can see how your performance is. And there's a chart, or the capital flow chart, that I actually love looking at because there's a blue line that shows your net investment. So this is just the dollars that you've put in, and essentially represents what would the balance be if you had kept this in cash the whole time. And then on top of that is the actual value of the portfolio based on the invested money. And so even in downturns, especially if they've been invested for a long time, when that market goes down, it's still higher than it was had you just kept it in cash the whole time. Oftentimes, depending on the timing of it, obviously.
Right,
but that's something that if you have an advisor, look into that and see, so to help calm your fears a little bit. If you see your portfolio's lost a lot of money from the previous day, just remind yourself, it's actually still probably better off than it was had I just been in cash this whole time, potentially, depending on a lot of things. But
just being in cash this whole time. I saw a chart the other day where, I mean, it just shows how much inflation eats into cash.
Sure.
So even just in cash, you're kind of practically still losing money as the dollar loses value.
Yes. Yeah. There's other risks at play to just keeping your money in cash. You should have some cash, but not your entire portfolio should not be in cash, is our conviction.
Yeah. Do you remember much of this one?
I mean, obviously I was a senior in high school, so I remember my senior year of high school. Did I care? No. Did it impact me in any significant way? No, not at all. Because I was working as a waiter. I didn't.
Were people talking about it? Like
probably.
Could you hear people talking about it at tables or anything?
Yeah, I'm trying to think. Like, I was focused on my life. I was focused on what I was doing. To be honest, I was a selfish 17-year-old. Right? I was playing music and doing my own thing. I didn't care about people's portfolios at all because it didn't really impact my parents too much. They, it didn't have a significant impact on what I was experiencing at the time. So
investing wasn't on your radar at this point?
Not at all. Yeah.
because at this point I had done a little bit of just kind of bland mutual fund investing. I remember the first investment that my dad had helped me pick out. I think when I was 17. It was before I could legally open my own account. He had to be on the account, so I was still a minor. It was a relatively conservative kind of total return type fund. So I saw it affect that a little bit. But I mean, at that point, I probably had $1,000 or $2,000 invested in it. But for a college kid, that's a decent amount.
Definitely.
But it was also a good way for me to kind of learn, like, this. I've put this away to just kind of grow. And right now it's not growing, but I'm just gonna keep watching it.
Yep. Yeah. And that's great. Because again, the psychological aspect, it feels painful and it feels like it might never end in the moment. When you're in the midst of it and you see the markets crashing potentially day after day, you're just going, what is happening right now? And it's important to remember the recoveries historically have come quickly, and maybe not fully. It might take a while for it to fully recover, but you don't want to miss those good days. And we're gonna go through a hypothetical at the end that highlights this in a 20-year period, how significant it can impact your portfolio if you were to panic and miss some of these rallies.
The other thing about this one, we were talking a little bit earlier prior to the podcast about days in your life that you remember where you were.
Yeah.
And this one, I mean, I think for me it was a little bit easier, or just because of the applicability of what I was studying at the time. But I remember I went to Gordon College. We had chapel 3 days a week, and I remember sitting in chapel and kind of discussing with friends because Bear Stearns had fallen, Lehman Brothers had fallen, and then I think it was early 2009 when the government came out and said, "All right, we're going to bail out AIG." And we were like, wow, like they didn't bail out Bear Stearns or like I just remember sitting in chapel and having that conversation.
Yeah. Yeah, I love that. There's this, we all remember where we were in historical events. And I think it's actually helpful to remember those things, because when the next one comes, there will be more downturns in the market in the future. More than likely. And it's important to remember, hey, we've been here before.
Yeah.
It's going to be okay. Last example, second to last. We'll still hit yours. March of 2020, the world shuts down. Planes are grounded, cities locked down, and millions were suddenly unemployed. Uncertainty grips the globe as investors fear the economic fallout. On March 16th, the Dow fell nearly 3,000 points in one day, the second worst drop ever. So this is the COVID crash that very quickly markets were, there was a lot of uncertainty in what was going on in the world, and that had an economic impact.
Yeah, I think this one was a bit different for that reason, because it was more than just I feel like the economic uncertainty was almost secondary in a lot of people's mind.
Sure.
So I think there were even, but it was still on people's minds. So I think there was even more kind of emotions that you had to try to figure out, with clients and talk them through the fact that, this is all happening and it's terrible, and the economy is almost entirely shut down, but it'll come back. I think it was a harder time because of the variety of reasons that emotions were at play.
Yeah. And this one's an interesting one in the history of our firm, because I was not with Stonecrop at this point, but this happens in March, and Stonecrop officially started when?
April 1st, 2020.
Exactly. So explain that, what that was like with dealing with that with clients.
Well, yeah, it's funny because we had we were kind of ramping up to start April 1st, but we had a transition period from January to April, and that wasn't the most fun transition period, because you go into, we're going to start a company with managing this much, and it vastly decreases during kind of end of February into March. So yeah, it was still clients were, we've seen this before. Markets are falling, markets are crashing, but markets have in the past always come back. So we've stress test financial plans. We're even rerunning financial plans now to make sure that you're still okay, and you are. And I think that shows the benefit of having a financial plan.
Yeah.
Seeing that, all right, my portfolio is 20, 30, 10, 20, 30, depending on how much you have in exposure to stocks. It's down that amount from February to almost end of March. I think March 23rd was the bottom. And then it from March 23rd to April 1st, it kind of quickly started growing again. It was a wild market. But yeah, that was an interesting time for us.
Yeah. Yeah. So March 16th, the Dow drops 12.9%, almost 13%. On March 24th, like you said, March 23rd was kind of the worst. March 24th, the Dow jumped 11.4%. Its biggest one-day gain since 1933.
Yeah. The other interesting thing with this one is that people almost forgot that markets price in what's already known. I remember having a conversation with somebody in the industry who was saying that they were starting to get out of stocks because, and they used the example, the King of Prussia Mall is closed. Retail is completely at a halt. But the market already knows that. So the market already priced all of that in.
Yeah.
I think people start to forget that, and maybe it's because emotions are at play, but it's interesting. One of the kind of contrarian indicators that we watch is how much people think essentially they should be in the lower the confidence in stocks, kind of the more bullish the case to be in stocks. It's historically been kind of a contrarian indicator where it's actually good if people are less excited about stocks.
Yeah.
And yeah, definitely played out there.
Yeah. So if you sold on March 16th and you missed that March 24 rally, you would have lost a chance to nearly recover your portfolio or recover your prior week losses. So,
and I think this was it was certainly one of, if not the fastest recovery like ever.
Yeah. And then 2020 ended up, in spite of the craziness that was happening in the world, ended up being a fairly good year in the stock market. So,
and we've talked to plenty of people, clients or just potential clients or friends who got nervous and got out and potentially never got back in.
Yeah.
We still occasionally talk to somebody who's, I've been in cash since 2020.
Yeah.
So try not to do that.
And it reminds me a lot of what's happening this year. In April, we talked about in the cold opening, the Liberation Day, and things went down fast. And people were nervous. Clients were calling us. We talked to a guy that moved a significant amount of his portfolio into cash after that. And then markets rallied and are at near an all-time high right now. Like they've missed out if you've done that. If you missed out on those rallies and cut your portfolio down quite a bit by doing that. Yeah,
actually, it's funny. I remember remember that day well, the day where it was up whatever 9, 10, 11% depending on the index. I was driving to a meeting and it was like a 5-hour meeting. It was a kind of full day's worth of meetings. And there's one industry podcast that I like to listen to. Really respect the guys that are on the podcast. Very knowledgeable about the markets. But the one guy kept saying this, I don't know, this feels more like, what did he say? This feels more like sell the rip, not buy the dip. And then I got out of the meeting and I saw everything was up like 7, 8, 9%. I was like, wow, like he couldn't have been more wrong.
Yeah, exactly. It's so funny. So 2020 is a good example. Something to keep in mind that let's stay the course. Just do it. You'll be all right. We have a quick bonus one. This wasn't in our original notes, but you wanted to talk about it because you love this one. I didn't know about this. The flash crash of 2010.
Yeah, so this was May 6th, 2010. And again, I think because of the applicability of my life, the day stands out pretty well to me. Shortly after lunch, I think it officially started at about 2:30. I was in the library studying for finals, and I remember a friend walking in the library and saying, "Hey, have you checked the news? Have you seen the markets?" And I remember pulling out my phone and getting on the Wall Street Journal. I think it was actually required for a class that I was in to have a subscription to the Wall Street Journal, and people were freaking out. The market was just getting crushed.
Yeah.
And yeah, so there was a mutual fund that had essentially tried to unwind a market position, like an S&P future type position, and put in something like a market order where instead of trying to use different systems so that you don't affect the price of securities in the market, they just kind of threw this giant sell into the market, and it just started killing the price of the overall market. And then at that point, the high frequency traders were a big thing. I think that was right around the time when Michael Lewis had written a book about them, and so they started reacting and selling. And that all started at 2:30, but then the market started coming back at 2:45 after people kind of started realizing what went on, what was going on. But again, I mean, for the price to fall, it was both because a large position was being unwound that in not the most efficient way, but then that caused people to start panicking and selling. And if you sold between 2:30 and 2:45, you were going to lock in significant losses that were almost erased by the end of the day.
Right. Yeah. So this one's a unique one because for the majority of your casual investor, you wouldn't have had enough time to realize what was even going on to get out in that 15-minute window. But I think it illustrates the point that even these scary, like it was a scary drop. They don't even last a single day sometimes in this particular case. So had you panicked in that moment and been like, I don't want this to go any further, you would have missed out on the rally by the end of the day.
Yeah.
Crazy. All right. So the moral of the story, market timing is almost impossible.
Yeah.
You can get lucky for sure, but to consistently do it right and sell at its peak and buy at the lowest is a really, really difficult thing to do.
Yeah. And actually, I remember a client at one point who I wasn't around Stonecrop or even the professional world at this time, but a client in, I think it was 2007, had kind of called a crash coming and went to, I think went to cash or just went very conservative. And then in like 2009 or 10, got back into the markets, and that he actually got, it seemed like he got a little bit cocky because then as I worked with him, he would try to do it again and never get it right. But the fact that he got the one right made him think, oh, I can time the markets well.
Yeah. You basically need to guess both the exit and the entrance pretty perfectly in order for this to go really well for you.
And nobody knows the future. I mean, we're always looking at things that tell us whether or not we should potentially take a little bit of risk off the table, potentially add a little bit of hedging to a portfolio. But no, as much as people want us to, no financial advisor has a crystal ball that is going to tell them exactly when to get in and out of the markets.
Right. So there's this interesting chart that Visual Capitalists put together that I wanted to reference because this kind of highlights. Well, all right, you might have listened to all this and go, okay, that all sounds good, but let's put this into real dollars and put a hypothetical scenario in place. And so here's what they put together. You have $10,000 invested in the S&P 500 for 20 years, from January of 2003 to December of 2022. And so this includes two of our market crashes that we looked at, the 2008 one and the 2021, the COVID one. It's coming right on the tails of the dot-com bubble too.
And 2022 was one of the worst years ever as well.
True. Yeah, we didn't even talk about that.
Yeah, there wasn't as much volatility, but the fact that both stocks and bonds were down more than 10% was unbelievable, unheard of.
Yeah. And so this includes that time frame, plus the other two examples that we gave. So if you remained invested every single day with that $10,000, the portfolio by the end of it would have $64,844 by the end of that 20 years. If you missed just the 10 best days, now keep in mind, 20 years is 7,300 days. So just 10 of those, you would have $29,708. So that's a big difference from $64,000 or almost $65,000.
Yeah.
If you missed the best,
it's more than half.
Yeah. If you missed the best 20 days, the portfolio would be $17,800. If you missed the best 30 days, you would have $11,000. barely more than your initial investment. If you miss the best 40 days, you'd have $8,000 and now you've officially lost money on your investment. If you've missed the best 50 days, you'd have $5,746, so nearly cutting your investment in half. And if you miss the best 60 days, your portfolio would be $4,205. The good days are mingled amongst the bad days all over. To time it is trying to time it is an extremely risky move. Staying invested, in our opinion, is the best bet that you can have for your portfolio.
Yeah, absolutely. And I would say the thought that you can time it, I think you should just kind of check your motivations. We know kind of statistically what's going to happen if you remain invested, and the types of returns, at least historically, you would have gotten. And so timing it almost feels, the fact that you think that you can time the future when nobody knows the future feels like you might start getting a little bit greedy.
Yeah.
Again, focus on what you're trying to do in your life with your financial plan, not how can I just maximize the amount of money that I can make and then potentially destroy your financial plan.
Right. Yeah. And so like in that example with that chart, you just missing the best 10 days, that's not a lot. It nearly cuts your portfolio in half.
Yeah.
So keep that in mind when you're trying to do this, that you're putting yourself in a massively risky position. We preach this all the time, but patience, discipline, and just having a long-term focus really helps you stay the course. And
yeah, and that's not to say, oh, let me just throw my money in the S&P and let it ride. There are certainly things that we're watching and ways in which we're diversifying portfolios to hopefully cushion some of the losses.
Sure.
So yeah, absolutely ways to be smart about what's going on in the markets, things that could potentially lead up to a negative. But then there are potential ways that potential things you can put in place to remain in the market, but maybe not get. If the market's down 40, maybe you're down 38 in the stock portion of your portfolio, or something like that. And again, 40%. That was great financial crisis. That was unbelievable. But yeah, just know that when we say remain in we're not saying just throw it in the S&P and close your eyes.
Sure.
We're doing things on our end as we manage money to try to take advantage of different situations.
Yeah. Yeah. The investment team that you head up is very involved in the portfolios that we put together for our clients. It's not as simple as set it and forget it, though that might be the mentality that the client has as they invest money with us. We're looking at it. And
not even the worst mentality.
Yeah.
From the client side.
Right. Because we do believe that. Yeah. But the burden of managing it, we don't want that on our clients. We take a look at it and we're heavily involved in making sure that we're making the most strategic moves possible for maximum impact. But it's different than market timing. We're not buying and getting in and out of the market.
Yeah. You should never, in any financial advisor relationship, you should never open your accounts on one day and see, oh, I'm fully invested, and then the next day see, oh, I have $0 in the market.
Yes. Yeah. That's a red flag.
Yeah.
So come back to this episode the next time the markets are down, because it can help potentially remind you historically that the good days are potentially just around the corner. And the question is, will you be there for them, or will you have gotten out and panicked? We don't want that for you. So we encourage you to just stay the course and keep doing what you're doing. And
keep building what you're trying to build and let the portfolios do their thing.
Yeah. Thank you so much for listening to another episode of Plan to Prosper. And like and comment, subscribe, send us an email if you want, plantопроsper@stonecropadvisors.com. We'd love to talk to you, hear from you, and we hope you have a great week, and God bless.
God bless.
Investment advisory services offered through Stonecrop Wealth Advisors, LLC, a registered investment advisor with the U.S. Securities and Exchange Commission. This material is intended for informational purposes only.